All right, everybody, welcome to another interview of the Next Big Rush. Today I have Andy from Finding Value Finance. It's hard to say.
Hmm.
Finding Value Finance. Welcome, Andy.
Yeah, thanks for having me on. Appreciate it.
No problem. Listen, you and I have spoken a little bit about our investment thesis and what we like in the market out there, but I've never really heard your story. How on earth did you start your sort of investing life, and how did you land on this little corner of the investing world? I'm going to call it the energy corner of the world.
Yeah, so I started out, going through college. I got a degree in engineering. Went out to work and get an engineering job. And then I started, noticing the paychecks, started noticing everything. I was like, this doesn't pay that well. I mean, that's just kind of what I thought at the time. I was like, man, I don't want to do this forever. So I got interested in investing right then and there. I was like, how can I grow my income? How can I grow my wealth? How can I essentially stop working, even though I just started working in
Mhm.
the engineering field? And it's not that I don't like engineering. I mean, I do and I don't. There's positives and negatives about anything that you do work related. I think I just was attracted to the freedom that it allowed. So the freedom to do what I want, when I want, and how I want to do it. So that's, I think, what drawn me to, or drew me to the investing world. And during that time frame, that was back in the mid 2000s. It was in the middle of a commodity bull market, and I saw and experienced this bull market right at the beginning of me investing. So I saw all the large returns on the back half of the 2000 to 2008 bull market. And one of the best performers that I saw during that time frame was oil and natural gas. So natural gas was the first thing that I saw, where I saw companies just do some crazy stuff, much like uranium, much like some of these other ones, 100 bagger plus type returns in some of these small natural gas companies that came about during the beginning of that bull market, and then developed reserves and produced assets and basically became large companies. So I did not see any other company come close to those types of returns in the time frame that I saw during that time frame. So I am naturally drawn to the commodity market because you can make, and I like this quote, decades of returns in years, or decades of returns in less than a decade. So that's what draws me to commodities. I think it's a really interesting area. I also think that the imbalances in the market are quite great in commodities, which means that you can get good companies at dirt cheap prices, and that can reverse so quickly to the upside that you just don't see that anywhere else in the markets.
So in
So
other words, you got spoiled for life, and now you're chasing big returns instead of just the usual boring tech stocks or growth stocks way back when that worked. You want the massive returns.
yeah, so the regular stocks, they kind of go up and down, percent, 2%, 3%. It's like a big day. Um, these commodity stocks, they can do like just ridiculous stuff in very short periods of time. You can get 100, 200, 300% returns in a month or two, or in a summer or something like that. So that's what draws me to it, is the large returns in a short period of time. Now, just because I started in that era in the beginning of the last bull market, or in the middle of the last bull market, I was not a good investor. Like, I didn't know what I was doing. I mean, I saw everything, but I didn't know how to capitalize on it. I was just a kid in his early 20s watching all this. I didn't know which companies, I didn't know, which sectors were the best. I didn't know if I should buy and hold, trade in and out. I mean, I was lost. I was lost like everyone else when they first start investing. I started listening to some of these people on YouTube, the Mike Maloney's of the world and Peter Schiff and all those guys. And I'll just say that it was good that I did that. I'll just say a lot of things were not 100% right. Their timing was off. And I just developed my own, I guess, approach to everything over the next like 5 or 10 years. And I always had that seed that was planted in the back of my head that a commodity bull market will come back around. And when that time comes, I'm going to capitalize on this like no other. Take all of, take everything that I've learned in the past from the first bull market, take everything that I've researched and gathered between the two bull markets, and then apply it to this next bull market. Some of those things that I've learned is to not trade in and out, to hold on. Don't chase price, go after the value, go after the chart pattern, go after the ratio, whatever's cheap in relationship to other assets, and then sit in it, wait, and then let that appreciate over the bull market. So it's the market conditions are what prices these assets. Think of it as shortages, deficits, shortages, those types of things, and the prices will come next. So that's kind of what my approach has been over these years. It's get slaughtered in the first half, not knowing what you're doing, figuring out what to do. Now going forward, basically just running off of what I've learned and pass it through my filters and figuring out what works for me. And I don't really listen to these so-called experts anymore. I kind of just, I'll listen to their side. I'll run it through my filters, and a lot of the stuff I just disagree with. Not all of it, but some of it.
Now, my question is, you said that you're looking at different ratios. What were some of the signals that made you go long in this sort of energy bull market that I believe we're living in right now? Or were you always positioned, from a long time ago? Like, how did you decide this is the time, this is it?
So I was heavily in technology in mid to late 2010s. So I was tech. I own companies like the Trade Desk, Roku, Chipotle even. I know it's not a tech company. MasterCard, Visa, like all those types of companies. I had basically my wealth was there. United Health Group, Anthem, Blue Cross Blue Shield, lots of those companies. Then as we came to the late, like 2018, 2019, 2020, that type of era, when I saw the ratio of oil to gold spike above 30, go above 50, go above 100, I was like, oh my God, this is a huge opportunity. I started like shaking at night because I was like, I gotta find these companies that are just gonna kill it. And that's when I knew it was time to go really long in oil, which was the bottom of 2020. And I was like, this is it. And I bought it not at the bottom of the bottom. I didn't buy it in March or April. I actually went into gold and silver stocks, and I swapped it in September, October of 2020. And I was guessing usually gold and silver do very well when the money supply goes up. And I know that they printed a bunch of money. I just went there, and then I rotated it a little bit later into oil into oil, natural gas, and uranium, because those were the most leveraged markets in the market of the past bull markets. And the way that I figured that out is that I used ratios and compared ratios of historical setups of the 1970s and the 2000s and compared it to today. And if you look at those ratios, the ones that have the largest leverage to a price move in a commodity bull market are uranium, natural gas, and oil. And they kind of hockey stick higher. So then after I knew that those were the highest leveraged areas, I said, well, what's the risk of going into these buckets of these different sectors? Uranium's a little bit different risk because they don't make money. So I was like, they don't have a lot of cash flow. Like, how are they going to, you're going into a more speculative type of investment because of the companies, not the uranium sector itself is more speculative. It's the companies that you can play it with. So I overweighted oil, natural gas because of the company's cash flows and infrastructures, and everything was already set up. Uranium, I still went heavy in. Don't get me wrong, it's a huge opportunity, but I just I couldn't put as much into it. I couldn't like leverage my knowledge of the timing and everything into these companies that just don't have anything to show for it in terms of cash flow. So I went far more heavy into oil, natural gas, exploration, production, because I thought, cycle wise and just what my thoughts were is that they're going to be the first benefactors of price going up is those companies. Plus, a lot of them had a lot of debt and they had the infrastructure in place. They had the cash flow generation possibility already all set up. Now it's just an ultra highly leveraged play to the price of the commodity. So
Okay,
I chose
so
oil
go
and
ahead.
natural gas as my cash flow potential out in the future,
Mhm.
with it being sold off to pennies on the dollar, like 99% declines in some of
Wow.
the companies. So that's how I played it. And that's what I looked for. The ratio being 50 and over of 1 ounce could buy more than 50 barrels of oil. That's an anomaly in history, never seen before. And then the companies being sold off 99%, off their highs. And then I also used the expansionary phase of real estate as another backing, because historically, commodities do well in an inflationary environment. The environment that I saw in real estate's the driver, I think, of that environment. It's demographics coming into home buying years. And that demographic puts an inflationary thrust into the market. It's the expansion of the loans into the system, which is inflationary. So the 70s was the demographic of the baby boomers coming into home buying years. This is the millennials demographic coming into home buying years. So that was also a huge tailwind that decided, look, I need to go big on this at that 2020 time frame.
That is super interesting. So you mentioned some of the different I guess numbers that you were looking at in different ratios. I had never heard of the gold to oil ratio, but obviously you can compare anything to the price of anything. But I'm very familiar with the silver to gold or gold to silver ratio. So for a person, and I know most of the followers here on the channel know and understand to a certain extent mining, to somebody who already knows mining, what is sort of the big picture, I guess, bull case for oil today? And what I mean today is it's all fine and good for you to tell me that, you're bullish oil because you've entered it, much before maybe any one of us here watching. Why do you still think it's a good bull case?
Yeah, so oil is the number one commodity. It basically is one of the things that makes the world go round. So number one is oil, number two is silver. So those are the two big commodities I really like because of the utility in society and its versatility in society. As a bull case for energy at this exact point, what I would say is the companies today are throwing off cash flows, which are massive. Their valuation historically, given their cash flows, their valuations are usually between 5 and 6x of their cash flow, their market cap, so to speak. And right now, their cash flows are way lower than that. They're 1, 2, 3 times their valuation of their cash flow. So from a cash flow perspective, they are incredibly cheap. Historically, though, when you look at commodity bull markets, cash flows go up at the top of a bull market. And then you want to sell them when everything looks good. And then you want to buy them when everything looks bad. But when looking at this bull market, there's no real supply response and the inventories are still incredibly low. That we're eating through inventories. So the imbalance in the system isn't fixed, and you can buy assets where the problem is at for really cheap. So I think the imbalances are still there. I think the imbalances will be there for a while. And I think the companies are going to make obscene amounts of money, and they are cheap right now in terms of cash flow. You can't say that with many other sectors. A lot of the other sectors like uranium, they don't have any cash flows. So how do you value some of these companies? Although I do think uranium is going to do incredible things out in the future. So I think today, because of the cash flows, because of the valuation is still cheap of oil to gold, we're at about 1 to 19 ratio, 1 to 20, 1 to 18. It's going in that vicinity in there. I don't see an overvalued spot. I still think it's cheap. And the upside potential, the risk reward, I think is greater now. It's actually less risky and has great rewards because of the cash flow. And what these companies are going to do and what they've projected that they're going to do is they're going to buy all their shares back. Well, not all of them, but a large percent. They're going to put back into the company and buy their shares and then give dividends after their debt's all repaid. So they've got a good vision. I think a lot of these companies are very well run. And I think that the money's going to eventually work its way back to the shareholder.
So when we look at mining stocks, I kind of try to take a sort of broad look at the ecosystem, right? So when somebody asks me about how to invest in mining, I have to kind of run through them, the different options that they have. So if you want to invest in gold, for instance, you can go for an ETF. You can actually buy the physical commodity in the form of coins or, bars or, digital gold. There are many different ways of buying the commodity itself. But then you have the mining companies. And within that sort of world, you're going to have the juniors, pre-discovery. Then you have the developers. You also have the producers, and within the producers, you have larger ones, smaller ones, and companies of all types. And on top of that, you have royalty companies that are basically just financial companies that deal with financing these gold projects, but then they get paid in the commodity itself, and so they make a lot of money as a result of that. What does the ecosystem look like for oil, if we're to make a comparison?
Yeah, so I don't know if there's a direct comparison to they have royalties. I'm not a big fan of the royalty companies because usually they have an asset, they deplete the asset, and then they don't really replenish it. I like the exploration production companies, especially in the beginning of a bull market, because they are going to be producing a bunch of cash. And that's kind of the first one who gets their hands on it. Then after that, you'll see the energy service companies do very well. So I think the exploration production companies, they've already kind of taken off. They've got massive returns, but they're still cheap in relationship to how much they are getting in terms of cash flows. The energy service companies haven't had that run yet. So the capital is going to turn and go to them next. So I think that's kind of the next step in the bull market, is that the energy service companies will do very well. The royalty companies, I don't like them in the energy sector as much, just because I don't see them growing their production or keeping a flat production. Usually they just decline, and then they run out of the asset and it's done with some of the royalties. So I much prefer production exploration in certain areas that can still grow their reserves, that can still grow their production, and then the energy service companies that are helping them do that. Those are the two areas that I like.
So what's oil exploration like? Because when you talk about mining exploration, it's mostly some geos that run around with their hammers and crayons, and they're trying to find a deposit, but rarely do they find an economic deposit. How does that translate to the oil world? Is it as hard to find economic oil deposits, or has the technology kind of caught up to actually finding oil fields?
Yeah, so I think they've got a lot of, you can have a lot of land next to producing fields. And then they do the same thing. They poke holes in the ground basically, and then they can see what's down there, and then they can add to their reserves. So I think it's very similar in that respect. I mean, it is a little bit different. Maybe it's more like in situ mining, where they inject things through. It's very similar to that, where they drill holes, they inject fluids, and then those fluids kind of bring everything to the top and come out of the well. That's, I guess, water flooding and stuff like that. I'm not like an expert in the mining portion of it. What I'm really good at, or at least what my perception is of what I'm good at, is taking a 50,000 foot view and then finding the value all in the markets, like where it's at, where it's located. And then I look for companies that could maybe potentially have good leverage to that price move. So I don't like dive way down where I have like a huge expertise in, say, how some of this stuff is actually brought out of the ground. That's where I'll revert to somebody who's like an oil petroleum engineer, or someone who's got more experience with actually taking it out of the ground. So I refer to them, and when it comes to that case, to get I'd say further insights on what companies might be good from a fundamental perspective, from a management perspective and stuff like that. But from I think I'm just good at the 50,000 foot view, saying this sector's cheap, this sector's cheap. How do I play it? Then you look at the charts. The charts will show you large fractals in those charts and say, hey, look, this thing's got a lot of leverage to the move. Usually they're high cost companies, ones that have break-even points that are much higher than other companies. That's your leverage, or they have a lot of debt. And then you have to watch out for those companies potentially going into bankruptcy at the bottom.
That is somewhat
So
similar to what
yeah, that's what
attracts
I
me
think.
investing. Yeah.
Yep.
Cool. And what are some of the companies that you think are still cheap in the sector? Are you able to provide us with some names or tickers?
Yeah, so I try not to go too deep into the names just because I've got the website and I don't want to do disservice to a lot of the people that are members there. But energy service is the spot that I'd be looking right now in terms of a sector. And I think there's a lot of good opportunities in energy services. If you were to look at the ETF OIH and you were to look and compare that to other sectors through ratio analysis or whatever, you can see that there's some very good opportunities in energy service in relationship to all the other potential investments, like even rare earth metals, uranium, like anything. They look very cheap and they're turning up in a positive way against those other ETFs. So that's kind of the area that I like. I can share one that we've entered here recently. Helix Energy Solutions is one that we entered recently. It's a smaller kind of offshore energy service company, and it went right to a tip. Their financials are starting to turn around. It's going to take some time because you're trying to buy a bottom, and it's starting to come on up.
Cool. So does the chart look kind of crappy for now? Because that's what I like.
I just started moving to the upside.
Okay,
we had
good.
a big bounce.
That's
A
good
lot
enough.
of these energy service companies have had a good bounce the past couple of weeks, say month.
But if you
And
zoom out, it looks like hell, correct?
Yes, it is
Okay.
way down. It is way down. It
Nice.
was I'll say it's a company that traded at $50, $60 back in the day. It traded all the way down to $2. You know, it bottomed at $1, came back down to like $2, and it's somewhere in that range. Now it's bounced up a little bit. It's probably $5 or $6 right now as it broke out of this gigantic pattern and starting to move on to the upside.
Still massive, massive down from its peak.
Yes.
And when was the peak, by the way, for these stocks in general?
Well, a lot of them stayed pretty elevated back till about 2014.
Okay.
So I'd say 2014, it may not have been the peak. The peak could have been 2008 for some of them. Some of them peaked in 2011, 2012, 2013, 2014, somewhere in that range. So you had kind of like a top, the 2008, 2009 pullback, and then it came back up, and then it rolled back over from 2014 till today. The bear market has been pretty brutal on a lot of these companies. And just like uranium and some of these other sectors, it's been pretty bad.
Yeah, I can imagine. No, I remember, I don't remember the year, but I do remember looking at oil stocks several years ago. And number one, I didn't understand, what was happening in the industry. I don't understand oil. It's something that I'm starting to learn now, thanks to you, and a couple of other people on Twitter. But I remember distinctively looking at charts and just really scratching my head thinking like, this company is not going to survive. And I go to another one, I'm like, how is this possible? And then the chart just looks like absolute mayhem, just an eternal downhill struggle. And it just did not look good. Like the whole sector was absolutely obliterated. So it must have been, 2014 or thereafter that I looked at them, but it spooked me. I'm not gonna lie. Back then I don't think I was as contrarian as I am today, and obviously I didn't have the experience that I have today. But it just made me completely scratch my head and go, "What on earth are these people thinking? How could they ever come out of this?"
The best entry points are the ones that scare you a little bit.
Absolutely,
a lot.
Yeah.
You're like,
I know.
I don't know how they're going to get out of this. And what I did is I said, look, the ratio's here. Commodities are number one. or the number one commodity. I heard Kathy Wood saying oil's never going over $20 a barrel. And I'm like, I'm good with this. I'm putting
All
a lot
in.
more in since she said that. It's
Good move.
it's
That's a
funny.
really good move.
I just went opposite of her.
That's awesome. And what would the bear thesis be for oil? Because I like to think of, our blind spots and the things that we aren't thinking of that might actually hurt us either in the mid to long term. Like what could make oil or oil services not as awesome as you imagine they will be?
A large population reduction. That's what could do it. I think that I don't think there's any serious. All the bear cases are going to be bull cases at some point, so it's hard to get a good read.
What do you mean
I
by
don't think there's
that?
any.
That
I can't think
the
of any
bear
long
cases
term or
become
medium
bull
term.
cases?
What's that?
What do you mean by all of the bear cases will become bull cases?
Well, if someone says that we're going to have a gigantic surge in renewable energy, and renewable energy is going to replace oil, and then my question would then be, well, how are you going to mine all of this? Where are you going to get this energy to do it? And they're going to be like, oh, well, it just poof from, fairyland, whatever energy source. And I'm like, it's all coming from oil, natural gas, and coal. And all the bear market cases where, if oil gets too expensive, renewables will replace it. It's actually not the case because renewables become far too expensive and they can't replace oil if oil is expensive. Does that make sense? Because the number one input for renewables is energy, and they become less affordable as energy goes up. So it's solar and a lot of these other areas are subsidized by oil and natural gas. So in order to have this, you have to burn the crap out of oil and natural gas. So I don't know of a bear case at this time. I mean, maybe you can't even do electric vehicles if we just don't have the minerals to do it. So that's how I became such a bull, is because it's the lack of the bear that makes me so bullish. Is I look at the bear case and I'm like, guys, your vision of what you think can happen can't happen without crossing a massive amount of oil. And I don't even think the oil is out there to make that vision that a lot of these politicians have even come true. Like, I don't think it exists out there. So I don't know it. We would have to go to fusion or something, but I don't think we're that close to it. And we could massively adopt nuclear, but that doesn't necessarily solve your problem because it generates a bunch of electricity. And then it's like, well, okay, so how do you store this electricity? And then you get into this gigantic problem of how do you store electricity? It won't be through batteries because then you're going to go into a gigantic mining boom. You go to the electric vehicles, you don't have the minerals to build that many electric vehicles. Even if you were to replace all of America with electric vehicles, you still got the S curves of India and China and all these other countries ramping up their use of whatever they can burn, doesn't matter what it is. Coal, natural gas, oil, they're just trying to become richer. And if they go into any sort of adoption of energy, that's an infinite increase because they weren't using it before. So you've got this demand where it's insatiable, like it basically wants whatever you can feed it. And I don't know if the energy is out there to feed it to the extent of wealth that they want to get to. So for instance, I don't know if they can become like Americans in the amount of people that they have, because the oil doesn't exist, the natural gas. I mean, we'll see if we can produce at those flow rates to get that amount of wealth creation in those countries. I just don't know if it's possible. And I think that, when looking at oil, we were talking about peak oil back in the last commodity bull market. Peak oil is where the volume goes up to a certain extent and then it turns and goes back down. That's the volume. And it's not the energy that goes back to society that can be used in society to produce work. As we bring on lower and lower energy returning fields and we go after less quality oil fields, the returns of that energy to society go down. So in a volume perspective, if you want to maintain this very wealthy lifestyle, you're going to have to produce more volume to stay flat. But at the same time, you've got these decline rates coming from existing fields that are in the range of, we'll say, 6 to 10%. And as you go up, you're losing more decline rates as you keep going up. So I think that we're close probably to a peak in oil production over the next 10 years, 20 years. And I think the world's going to take every single drop that we can produce of it. And I think that we're going to hit a spot where we are going to run into deficits of oil. And I'm not trying to do this from like a, how can I say it, like a gloomy perspective. I'm just saying, like, I think it's inevitable at some point that we're going to hit some constraints. And maybe that's where your AI and all that other stuff comes into play to try to figure out how to sidestep this kind of oil trajectory where we kind of peak in it over the next 10, 20 years. So oil, I think, given where we are today, I think could cause havoc in the world, because if you look at our energy consumption, it's directly related to GDP. If we can't grow energy, then your GDP can't grow, much at all. And if you've got a debt-based system that's just going vertical, you have an imbalance between money chasing fewer goods, which is inflationary.
Absolutely.
And I think that's the environment that we're entering.
What do you think governments can do about this, if anything?
I think the best course of action is to allow as much as we can to produce in the short term and incentivize more production of anything, just like open it up, let it go. And the free markets hopefully can take it from there. The transition, you don't want to restrain, or you don't want to constrain something where you stop production and then like open it and shut it, basically based off of like election cycles. I think it's too herky jerky. You kind of just have to like let it be normal, let it sit and say, this is where we can produce, this is where we can't, and just let it go. And then hopefully there is solutions to our problems. And we can figure out other means to harness energy or gather energy or produce it from whatever, and become a lot more efficient in our use of it. So
Yeah.
I mean, hopefully that's the case.
And hopefully, the world won't starve in the process, because it seems like the price of everything is going up, and checks are being written, I guess, to support the lower base of the pyramid socially.
Well, you don't want to get into wars. That's over commodities or over resources, which I think will happen.
You
That's
do
what
actually think that the world is going to war? You mean like the developed world, or do you think like smaller countries?
So I think we're already at war. I think Russia is going to war against the United States. It just doesn't seem that way. They think it's between Ukraine and Russia. I think it's the East versus the West. It's already started, and they're going to attack our currency. And our response to that, to the cutting of natural gas, the cutting of energy, their unwillingness to accept currencies that aren't worth anything, which I agree with that. I mean, that makes sense from their side of things. And then I think they're going to go after our currencies and dive bomb them. Like, they're going to try to crash the currency. So our response is probably to increase interest rates as high as we can and protect the dollar at all costs. That's why they may sacrifice they may have a really bad recession to protect that. But the way that I view these things is all the wealth in the world is in the commodities, and it's in usable products that use these commodities. That's where all the wealth is. You can't just print this paper, hand it out to people, and think that they're going to be satisfied over an indefinite time frame. So I understand both sides of this, conflict. And I think eventually the person who's just printing pieces of paper is going to lose. because they're gonna migrate away from that, and they're gonna go to things that have real value. And I think over time, as resources get a little bit more scarce, that's going to be very apparent. That's my take over the next long period.
Mhm.
Now, AI can delay this, but it won't stop it. It can accelerate it. It can delay it and accelerate it. So as we get more efficient at pulling something out of the ground, it just means that thing that's in the ground will be, you know, extracted quicker. Doesn't mean I mean, we could enhance the recoverable amounts if you can balance it out from an energy return to energy invested perspective, because money doesn't matter. Money is just it's a way to transact. It's the energy returns and the amount of energy in the system that is it able to do work that matters. I'm looking at this from like a physics, chemistry, engineering type movement. The business side, it's like, yeah, you guys, you can play with numbers, you can play with money. That doesn't really solve an issue. You need energy in a system, and you need surplus energy to keep it running. And we're seeing that energy returns dive bomb on a lot of the oil. You know, you can extract it. We're digging oil out of sand. I mean, that's kind of ridiculous if you think about it. And our returns are only 3 to 1. If your returns are 3, 4 to 1, which means 1 barrel of energy you put in, you get 3, 4 back, that can't sustain a complex society. It ceases to exist. We're already extracting things that a complex society cannot be sustained on. Renewables, it can't be sustained on. So, you know, I'm looking at this going, well, we're already doing it. Now it's just a matter of when is this hit going to come where real things with embedded energy in it become ultra valuable. Because we came from a low, we'll call it, we came from a surplus of energy environment into what I think, I'm looking big long term, not like a year or two. I'm looking at a decade or two out, where we have much higher energy costs out in the future. It's gonna destroy currencies. Bond markets can't survive that, I don't think, for a length of time. So it depends how fast we have solutions out in the front. Depends how we can respond and react to it. But if you've got a debt system that's going at an exponential pace and your energy kind of just tails off, you know, with a decline rate, then your currency, I don't think, can handle that. Then you go back to gold and silver. But mining, you know, the mining companies, that gets you in a weird spot too, because they're a large consumption of energy. And if your ore grades are going to nothing, you know, asymptotically approaching zero, which means like you get close to zero, but you never actually hit it, your ore grades, your energy inputs go up exponentially. So in order to have this wealth that everybody wants, in order to have the copper, the nickel, all this stuff, you're going to eat through so much energy. It's going to be, I think it's going to be a big task to increase production of those things with declining ore grades.
That's a really interesting take, especially as, we look at copper and, well, they call it Dr. Copper, for a reason, because it's usually a reflection of the economy on the demand side. And copper grades have been declining rapidly. And I don't think most people are, considering the fact that mining is highly energy intensive, and that if we're going to continue this energy boom price-wise, cost-wise, that is definitely going to hurt, a lot of the mining players. Very interesting. Andy, I always learn so much when I speak with you. Thank you so much for coming on. Is there anything that you want to leave my viewers with, and where can they find you?
Yeah, so you can find me on Twitter, at finding_finance. You can follow me on YouTube. I've got a YouTube channel as well. It's Finding Value Finance, if you want to search for that. I also have a website that's up here. If you want to join, it is a paid for membership site. So you can look at that if you'd like. And to leave on, I think that we're coming up to a period that is different from the last 40 years. The last 40 years was a disinflationary environment from early 1980s, all the way till about 2020. That disinflationary environment is an environment where stocks and bonds did incredibly well from a declining interest rate environment. going forward, we could see a more inflationary environment where interest rates go up, where those interest rates go up, and they're not going to go up, straight. They're going to move up, pull back, move up, pull back, and that type of movement. It's going to price assets differently in that type of environment. And real things, in my opinion, are going to outperform these kind of technology companies, which are much more rooted in future growth, which is rooted in future energy consumption. And if people realize, and if that is right, that energy consumption may be constrained in the future for a little while, those companies are not going to do very well, because they are priced based off of future earnings, and everything in the future requires future energy. And if someone says, hey, look, we don't have that energy out there, then the current valuation of a lot of these companies, I think, will go down. Another aspect to think about it is greater percentages of normal people, their income is going to transfer and go towards energy consumption, food, and shelter. So it's going to divert more towards those, and less of that money is going to go towards technology and other types of companies. So I think, and obviously it's just my opinion, that money is going to go and forcefully go to them, because they have to pay for it. And I think the money is going to go there from an investment standpoint to solve those problems. And I think it's going to take 5 years to a decade to solve, if we can solve it, that kind of time frame. I know a lot of people think that technology is the savior of a lot of this stuff. And, I would say I partially agree and disagree, because, as technology has progressed, we've seen like airplanes. They'd say, oh, well, who would drive an, who'd fly an airplane or whatever. And then they got these massive airplanes. They got these gigantic turbine engines on them, and then they made them super cheap to go on. So what happened? They say, well, we got this really efficient airplane. It's more efficient than ever before. The efficiency drove costs down, so now everyone's flying everywhere. So as efficiency increases, adoption increases. And as adoption increases, your ability to eat through the resources on the world becomes greater. So I'm not saying that we shouldn't be extracting our resources or anything like that. It's just the carrying capacity of Earth will go to a level that technology will allow us to go to. But if that technology does fail us, watch out. That's all I'm going to say. Because you could see the back end kind of be a little bit nasty whenever that happens. I don't know when that will happen, but and I'm not in the gloom camp. I'm not in the doom camp. I'm just looking at this going, hey, this is getting pretty crazy as we go vertical. I mean, everything's exponentially increasing, and I don't like exponentials as you get to very high levels where your doublings start going up very quickly, and you won't be able to see when that problem does hit. I do think that we're going to hit a problem somewhere with currencies, bond markets, and energy kind of all colliding together.
And on that happy note,
I know.
Just to be very clear, we do love it when the exponential is the price of the stuff that we've bought, right? Investment wise. So that's the only exponential that we like. All right, Andy, thank you so much. And let's do this again soon. Thank you very much. Everybody go and check out Andy on Twitter, and also go to his website, check his stuff out, and also actually run down here in the commentary section and let us know what have you learned today about oil, about mining, or any of the views discussed here, and you will be able to go straight to his channel and also follow him there. All right, thank you very much. Take care.